It is a very important presentation for the purposes of you to round out your offerings to your clients, round out your consultation, and to, of course, get paid for what it is that you do. So anyway, we're going to start where we left off yesterday. We were talking about making that transition about going from a fully insured contract to a self-funded contract. So here's some transitional things that you need to keep in mind. First of all, how will workers respond to the changes? So are the workers going to think that maybe that employer is not going to be around next year? Are they making changes that are a little bit on that financial side that doesn't make them feel good? So do they lose some trust in that employer? Got to think about how the employees will take the news. So that's a very strong conversation that you need to have with the employer to make sure that everybody's on the same page. And then aggressive cost containment measures, you want to use those carrots. You don't want to use sticks. If you penalize people for not participating in some of those cost containment measures, like we talked about with the wellness programs, the coaching, the case management and disease management, if you don't encourage people to do that with some rewards or the carrots, then you probably are going to get pretty lousy participation in those cost containment measures. And the workers may think that the special exceptions can be made with the employer making the decisions. They really don't understand how come they're not involved in making the decisions on their health care. This has been going around in America for quite some time. Why is it that employers make these decisions and not the employees? I have seen groups where the employees are very involved in the decision making, and it actually is kind of a nightmare. So if we can keep it to the employer's making the decision based on the financials of the company, based on the administration of the company, that's the best way for us to handle it. Now, how are the gaps in coverage avoided? So fully insured is based on incurred claims with runout coverage, meaning that when you're insured by a fully insured plan and claims come into that insurance company well after that plan has terminated, that insurance company is still on the hook for those claims because the date of incurred is during the time that folks are actually covered by that insurer. So that insurer is on the hook no matter how long it takes for those claims to get paid, even if that contract is terminated. Now, the self-funding is based on paid claims. And we've also seen it on an incurred basis as well, depending upon the contract that you have. So if it is based on purely paid claims and the contract ends at 12 months, anything that comes into the self-funded stop-loss insurance carrier will not get paid. They'll be done. And so you need to look at your contracts. And so we're going to be talking about run-out contracts, and we're going to be talking about run-in contracts. And we're going to be talking about lasering a condition to have it be funded by the employer rather than having it be funded by the stop-loss insurance carrier. And then fully insuring transplants also may make sense. So you can actually buy a rider to fully insure transplants, not have them be under the stop loss or the employer's deductible, if you will, for any kind of large claims. Now, the reason why you would see a carve-out rider on insuring transplants is because you could be on a waiting list for a transplant for quite some time, but the stop loss carrier knows that that employee is on a transplant list or that dependent is on a transplant list. And so that stop loss carrier will change the premiums according to that inevitable situation taking place. So if you take the transplant situation and carve it out and fully insure it, then the stop loss premiums will stay at a lower level. Now, renewal practices and philosophy that must be considered. Renewal practices and renewal philosophy vary widely among the insurers. And so you have to get to know your insurers as far as how it is they use a formulary to renew, especially those groups that are over 50 lives. You have to understand what kind of credibility they have, what kind of formula is attached to their own reinsurance plans, what claims do they keep in the mix, what claims do they throw out to the pool. Those are all things that you are required to know as a producer working with a variety of different insurers. And so that knowledge and that experience will be probably some of the most important renewal tactic that you will use with any size group that you have. Now, some will offer a renewal and some will non-renew based on the experience. So if you're in a self-funded arrangement and you are in a situation where the claims are super bad or your participation is super low, whatever, or maybe the group is just reduced in size as far as membership is concerned altogether. Those are all reasons why you could see your stop loss carrier saying, we just don't want you as a client anymore, and they're not going to non-renew. So be ready for that eventuality. Prepare your client. You can see this. You should be getting quarterly reports on membership from your stop loss carrier or from your administrator, so that you can actually see what the trend is on that group, so that you can warn them as you get closer to the renewal, maybe 6 months in, saying, hey, your membership has dropped by 50%. This could be a real problem at renewal time. Do you want to start working on your renewal right now? Let's get some census data together. Let's put this out to the market. Maybe we go back to fully insured. Some will offer laser underwriting as an option. So if that stop loss carrier is recognizing that there's an employee that's a really high risk employee, maybe that employee's on some specialty medications, maybe that employee is on end stage renal treatments with dialysis, or maybe that employee is, I don't know, any really large underwriting situations may put that stop loss carrier into a situation where they're offering a renewal, but they're only going to offer the renewal if that condition is no longer covered by the stop loss carrier. So what happens with that? So what happens is that the employer then assumes all risk. There is no stop loss insurance that is protecting that employer for that risk. Does that make sense in small group? Probably not, because they're never going to get enough premium collected to offset that large claim. When you're talking about very large groups, and they actually do have stop loss insurance, they're not just completely self-insured, that lasering could be easier because they have the money in reserves to pay for that person's medical condition. They pull it out of the underwriting, they pull it out of the renewal, and then the stop loss premiums remain in a very good way because that stop loss carrier is not assuming the risk. And so it's an overall strategy to keep the stop loss premiums as low as you can. But lasering in small group is not usually a very good idea. As a matter of fact, lasering was one of the things that the superintendent of insurance was very worried about in writing stop loss insurance for small group. So if you are working with a third party administrator, lasering is definitely in that as an underwriting option. However, if you are in a bundled AS your lasering is not something that they do. So they will keep everybody together. They won't take any conditions out of the renewal. So you do need to do your diligence on the MGU, the managing general underwriter, and the administrative services only companies to see that what ramifications of non-renewal are, and if they are a no laser underwriter, like I said. The ASOs, being the carriers themselves in the bundled, are probably going to be your best bet for no lasering. Now we're going to talk about managing the catastrophic through stop loss coverage. So here is a list of some of the top stop loss insurers across the nation. Obviously, Cigna is a huge player in New Mexico. They offer a variety of stop loss insurance plans. They have level funding as well as what they call graded funding. Theirs is a very unique model, and we'll talk about that in a minute. Now, Sun Life Financial, also one of the best stop loss carriers in the market. They like starting at group size 100. So you won't see them in that smaller group space. HCC Life Insurance, they'll go down into a smaller space, as well as HM Insurance Group. I have contracts out with Gerber and with Nationwide and with Standard Life Insurance Company. Those all are companies that are very happy to be in that smaller group market. Now, United Healthcare, of course, has their company called All Savers, and they are also very comfortable to be in that small group market. What is stop loss insurance and why is it important? So here's your definitions. Stop loss insurance provides protection to self-funded health plans that want to protect themselves from the large and unexpected losses that can arise when one plan participant has catastrophic medical bills. This is called the specific stop loss insurance. And then the insurance also used to protect a plan when there is a large loss resulting from unexpected number of smaller claims that are substantial in the aggregate is called the aggregate stop loss insurance. Now, when we look at the specific contracts, the limits that the plan sponsor's liability to be predetermined dollar amount on each covered participant usually is in the range between 10,000, we're talking small group now, $10,000, maybe as high as 40,000. I've got a chart on this coming up, but usually we don't see much more than that on the smaller size groups. On the larger groups, they can go much, much higher. It may be limited to medical coverage, though it may also include other things like your prescriptions, of course, and the specific contract does not cover expenses outside of the plan document or expenses related to the plan administration. So the administration, of course, is handled by the administrator, but expenses outside of that plan document, if you remember yesterday's discussion about, those exclusions, the state mandated exclusions, like we were talking about 24-hour coverage or temporomandibular joint disorder, or chiropractic or acupuncture, you got to look at that plan document, see what those excluded expenses are, and make sure that that contract is the way that you would like it to be for your employer. Now, there are two types of contracts. There's a run-in contract and there's a run-out contract. The run-in contracts are more expensive. What that means is that you are actually replacing another self-funded account that is ending on a 12-12 contract, that there's no tail, if you will, on claims after the contract year. So if you are taking over a group that has got a 12-12 run out type of a contract, then you might want to offer a run-in contract, a 15-12 or an 18-12 or a 24-12. The longer you go, the 24-12 is going to be most expensive. So if you do a 15-12, you're going to give 3 months of coverage with the new carrier actually covering things that may have happened under the old carrier. That's why it is considered to be more expensive. Now, the run out contracts are more popular, and we see those in the market most often. So that says with a 12-15 contract, that means that you got claims coming in for the 12 months of the contract year, and the carrier's on the hook to pay 3 more months past that 12 months in order to get the group paid up. 18 months, 24 months, we've seen them all, even out as far as 60 months with All Savers. So the longer the tail, the more expensive the contract. Just know that. So if you start getting bids back and you find that your tail is at 24 months, you might want to go back to your stop loss insurance and say, hey, will you please run me a different run out situation, maybe bring it down to 18 or maybe bring it down to 15. What is a specific stop loss attachment point? So this is that deductible, if you will, that the employer must pay first before the stop loss insurance kicks in. So if you are in a group of size of 5 to 50 covered employees, we usually see $10,000 up to $50,000 as that employer deductible before the specific insurance actually kicks in. Remember, New Mexico has a minimum of $10,000 in statute. Once you get over 50 employees, then you can get that up a little bit higher. So 50 to 100 employees, you can see anywhere from 25 to 75,000. 100 to 250 employees, 50 to 125,000. 251 to 1,000, all the way up to $250,000 as a deductible, and over 1,000, you can actually get to a $500,000 deductible before that stop loss kicks in. What is an aggregate stop loss attachment point? So the aggregate attachment point sets the maximum total dollar amount of claims a plan will have to pay in a specific period. Nearly 90% of all plans purchase about 125% of expected claims as their aggregate attachment point. Remember, New Mexico's statute is 110. So if you go down to 110 and not at 125, your premiums will be higher. Your aggregate stop loss insurance will be more expensive. Why? Because that means that the aggregate insurance is kicking in quicker. You need fewer claims aggregated together to get you to the aggregate insurance before it starts paying out. So at 125, you can see when you get your proposals in from the insurers, they will show you the minimum premium, they will show you the expected premium, and they will show you the maximum premium. And the maximum premium funds the 125%, if you will, of expected claims to be the maximum that the plan would have to pay out. So if the group wants to be ultra conservative, they are going to use those maximum premiums to share with the employees and to put into the reserve bank in the process of saving for the unexpected. This means if paid claims exceed the expected by 25%, that's where you're at your 125% of your plan for your attachment point. And then claims that reimbursed under specific stop loss do not apply to the aggregate stop loss threshold. That's a completely separate calculation. Here's some pictures of that. So the specific stop loss coverage is looking at those individual claims. They're looking at where the ceiling is on that stop loss. Maybe that ceiling is at, $30,000. That's where the threshold is. And then the red above that is where the stop loss carrier starts kicking in. Below that is the employer. And then on the aggregate side, it's just taking a bunch of those little claims and moving them together. And then the claims payments reach the aggregate of, calculating that 125 or 110. And then the stop loss will kick in. The aggregate stop loss will also kick in to help start paying for claims for the whole group. We talked a little bit about laser underwriting already. This will be for the high-risk diagnosis. A lot of people thought, in particular, the superintendent thought that lasering meant lasering the entire individual out of the plan, and that is not the correct thought process. Lasering is underwriting the condition, not the whole person. So if the person has got an end-stage renal disease situation going on and they're on dialysis, then the end-stage renal disease would be lasered out for any coverage under the stop loss insurance carrier. And the person then is still covered for anything else that may happen. If the person ends up with a broken limb or ends up in a car accident or something that would trigger a different type of claim, that person's still covered by the employer plan for those things. It's just the underwriting on the diagnosis that is not covered if the lasering kicks in. We already talked about transplants. And so that really is just a strategy to try to keep those stop loss premiums from going sky high when you've got some high risk individuals within your group. Here's some provisions on the contract. 1212 contract is an incurred and paid claims are included in the same policy year. It's a good contract for a stable account that is not in its first year. The 1215 contract, this is a run-out contract or a terminal liability contract. The incurred but not reported claims are run out over that 15-month period of time, provides protection for a period beyond the claims year, for 3 months, and it is good for those first-year programs. We do see that this contract quite often. It usually is the next lowest premium option next to the 1212 contract. And it also makes it a little bit easier to switch carriers and minimizes that gap liability from year to year. And then, of course, these run-in contracts, like I said, you're going to be taking over another stop-loss carrier that doesn't have any kind of run-out. And then the paid contracts pays all claims during the policy year, regardless of whether the date the claim was incurred falls within the policy effective dates. So those are most expensive contracts because they are not looking at the effective dates of the policy. And so we don't see those as often as we do the other contracts. The rolling stop loss contract, the 1215 year over year, is an example of what we see quite often, particularly with companies like Cigna And with Presbyterian and with Blue Cross, like I said, All Savers has got a tremendously long rolling stop loss contract out there for 60 months. And so the incurred contract accumulates based on incurred dates, based on rather than on paid dates, eliminates the variable of claim payment timing in order to protect the plan. Some stop loss contracts are sold on a reimbursement basis where the employer funds all the claims as they are paid and then is reimbursed by the stop loss insurance carrier after the end of the plan year. Some stop loss contracts are purchased on an advanced funding basis to protect the plan's cash flow from large shock claims or specific or a large number of small claims aggregate. Be sure you understand the stop loss funding mechanism to explain this to your client. Personally, I like the advanced funding better, particularly if you are in a small group arrangement. Lots of them cannot wait until the end of the year to get reimbursed on all the claims that they're paying out. So make sure you read your contract, make sure you understand what kind of a contract it is. Don't get them locked into a reimbursement contract if their cash flow is not such that it can handle waiting until the end of the year. And then there's this outlier called aggregating specific contract deductibles. It's kind of a way of stacking your policies so that you can start bringing that specific premium back down again. It is, and all claims cumulatively, one claim or any number of claims over a specified apply towards satisfying the aggregate specific. So once satisfied, remaining future claims over the specific deductible can be reimbursed. But it's really working collectively more in the aggregate being the first insurer rather than the specific being the first insurer. And chart is just showing, how those claims accumulate. This poor group has got some pretty nasty claims going on, 65,000, 75,000, and 55,000. They're aggregating them together. And so the employer gets money through that aggregation to help pay for the claims, but does not have to meet the specific deductibles yet until after the aggregate is done. Okay, now we're going to talk about level funding, which seems to be quite a popular way of addressing self-funding within the small group arena. It gets those small groups into a place where they have a little bit more control. It's very much lower risk. It looks more like a fully funded contract, but all the rules of self-funding still apply to it. So they still have to, meet the needs of the ERISA rules, and they have to meet the needs of the ACA rules for reporting and that type of thing. So you cannot be misrepresenting the level funded contracts to your clients for saying, hey, the insurer is going to take care of everything for you. That's not true. It is truly a self-funded arrangement. We call them partially self-funded because it does have that stop loss insurance in there, and it is, of course, a fixed premium. But just know that it is in that self-funded arena, and you do need to pay attention to all the rules that go along with that. Now, it combines the cost savings and customization of self-funding. So if you are with, say, Cigna, you can customize that plan design beautifully for your employers. And maybe the employer, really want to have low co-payments on primary care, and they want to have low co-payments for urgent care, and they want to have low co-payments for generics, and other incentives along the customization channel. And you can do that with Cigna. Other carriers don't have that capability of customization. All Savers doesn't allow customization, but they have a huge menu of plans to choose from. And so it's pretty good a chance that you'll find one that fits your customers' needs. Presbyterian has got their smaller list of self-funded, level-funded contracts, as does Blue Cross. Now, with the financial safety and predictability of the fully insured plans, you're kind of getting the same thing with the level contract. So you got it there. Nobody really wants to do this. But if you are offering a level funded contract to an employer group that has 2 to 50 employees and they're having a bad time with claims, and those rates just keep on going up and you're just not doing well with participation, at least you can get your group to move back into a fully insured guaranteed issue basis if you're working with groups of 2 to 50 and they're in a level funded contract. So the risk is not very high for that size group to be in a level funded contract. But if you want to get over 50, all bets are off. You're not going to be able to get back into that guarantee issue of fully insured. Employers still contract to their insurers, but agree to take on more of the financial risk, of course, and a self-funded arrangement. Four main components, of course, are your administrative costs, your claims costs, your specific stop loss costs, and your aggregate stop loss costs. Most of the time, I have been seeing specific and aggregate stop loss costs in a tiered fashion. They are not on just a single aggregate premium. It is usually broken up by single employee, employee spouse, employee child, and family. So make sure that, yeah, it's a pretty nice level way of, that they're not, ramping up the cost on the employee spouse too much or ramping up the cost on the employee family too much and then trying to keep that employee only premium lower. You can move around inside of these tiers with the carriers that do this. And so just know that might be a strategy, particularly if the group has got more employee onlys enrolled in the plan than any other tier. Here's a diagram of level premium funding. So when you look at the red line, year one claims, you got some lower claims. It's the premium itself is that yellow line. And so that year one, it's low, low, low. You're below the premium as far as what your claims look like. And then all of a sudden you see that spikes up and then it goes right back down again. So and then the year two claims are that blue line. The year, it looks really good. It's kind of right there with the premium, and then it drops down below the premium, but then it starts to rise again on the recovery. So what happens with level funding is if you have any claims that are going above the premium that you're actually collecting, because your premium doesn't change all throughout the year. It includes those four components that we talked about. It includes the administrative costs, the claims cost, specific stop loss, and aggregate stop loss. It's like the fully funded premium. It includes that. The employer pays the same amount every single month. But if your claims are falling above that, you will see that the premium is not going to change. The employer is not going to get an extra bill for the claims that are over and above that level premium. Likewise, they're not going to get a credit on their bill if the claims start falling below that level premium. So what happens at the end of the plan year, whether it's a 12-month plan year or a 15-month plan year, at the end of the plan year, what will happen is that the insurer will then assess where the level premium was, how much went into the claims bank, and how much was actually paid out of that claims bank for the plan. And if there is a surplus in that claims bank, then the employer can receive a credit against their administration of that level funded contract going forward. Or if the claims are above what they've saved in their claims bank, of course, they're going to see an adjustment in their premium assessment going forward for evaluating what their maximums may be, depending upon what the attachment point is on that aggregate. So they may change the aggregate attachment point. They may change the specific deductible, all to keep the premiums in line. But don't forget, the insurer has some good data at this point in time to look at what happened historically and what could go on in the future with particular claimants. They can see if a claim has been finished, if it was a shock claim like an accident that got resolved fairly quickly. And so all these are things that you as the producer need to be looking at in that renewal period so that you then advise your group correctly so that you can then go back to the insurer, maybe negotiate things, especially if you know from the employer, say a person that was in the group that had an ongoing claim is no longer in the group, and the group is not expecting them to elect COBRA. Their COBRA period is actually done. They didn't elect COBRA in that 6-day period. So that person is no longer even in the mix. Make sure the carrier understands that and knows that, especially if they're using that data to project forward and give you your rates as you go forward. So this is all really, really important information for you to analyze, for you to absorb, and for you to make a case for your group at renewal. Now, there are different ways of getting that surplus back to the employer. So some insurers give them 100% of their surplus at the end of that contract period, and some like Cigna will give you a percentage of that surplus. the way Cigna works their surplus refund is based on administrative charges. So if you elect a 50-50 split on the surplus, then your administration charges will be lower with Cigna. If you elect a 100% surplus back to the employer, your administrative charges with Cigna will go up, and they'll go up quite substantially. So just know that when you design your plans with Cigna, you have to choose how you want the surplus to be paid out in their level funded contract, and just know how it affects the overall calculation of the rate going forward with your groups. Most of the other carriers do not do this percentage of surplus arrangement. They're all working on that 100% of surplus going back to the employer in a good year. Now, the benefits to the small employer under the level funding arrangement is the fully insured plans are forecasted by the insurer based on its book of business and not the group. So there could be some cost savings to that group if they are a healthy group. So if they are really looking at year over year good claims and good healthy employees, then you could be benefiting that group by being in a level funded contract versus in a fully insured contract, which is based on the carrier's entire book of business and nothing really to do with the claims of that particular group. Level funded plans use experience for rating, which should save the group in forecasting at renewal with a surplus. Now, plan customization. This is a benefit. Like I said, you can have value-based designs going on with your group. You can have some of the mandated benefits in there, some of them not. That's your choice. You can vary that according to how you want to up the premium or lower the premium. And then, of course, the reduced in taxes, meaning the premium tax is not charged on the entire premium like it is on the fully insured plans. That premium tax is only charged on the stop loss premium. And so that is a much lower tax that the employer is paying because those stop loss premiums are much lower than the fully insured premium is. The federal health insurance tax never has been applied to the stop loss premium, even though that is going away, doesn't really matter. It was never applied to stop loss premiums anyway. So some of the drawbacks, though, to the small employer is that the CFO or other finance person in the office has absolutely no knowledge about this type of funding arrangement, and they just are lost. You can draw pictures for them, you can do charts, you can do face-to-face meetings talking about this, but somehow or another there's a block in their understanding of how this funding arrangement works. And if you see that the finance person in the office really is putting up a block on understanding how the funding works and how the reporting works and how the fiduciary responsibility works, then they're probably not a good candidate for self-funding. So it's probably a better idea for you not to be offering that type of program to them. Oops, sorry, touched my mouse. Go back. Also, the Affordable Care Act medical loss ratio, fully insureds must abide by that 85-15 rule, but the level funded plans don't have to adhere to that. Which means that you could be out of whack on your administration. Your administration could be well over 15%. It could be as high as 50% or as high as 60%. And so when you see that administration number of 50 to 60% of the premium, then you have to wonder, well, how much money is going into that claims bank? Am I ever going to get to a reserve level in my claims bank where I actually do reach a surplus? And so, if you've got so much going towards administration and not enough going into the reserves, you can pretty much count on that plan never hitting a surplus, never hitting a profit. And so you really need to understand your contract. You really need to look at the numbers. You need to look at the administrative cost. You need to look at the claims cost savings that are required reserve savings. You look at that stop loss premium, and then you look at how all that is distributed. And if you see that too much money is going to that administration, you got to warn the employer they're probably never going to get to a surplus. So don't sell level funding based on a surplus, because you will lose that conversation all day long if your administration is too high. So know your numbers, know how to compare them, know what goes into that reserve bank, and then question the carrier. Ask them if they really have to put that much towards administration. If you're looking at 100% of the surplus going back to the group, then you're probably going to see a pretty high administration number. So that's where, at least with Cigna, you can vary those numbers back and forth and get some money back through a 50-50 share, or maybe a 1/3, 2/3 share. So just know that there is a purpose behind all of that. The reporting, no matter the size of the group, all the 1094 and 1095 reporting is assumed by the group rather than the insurer. So even though the group is 25 employees, well below that ALE size, that group is on the hook for preparing both the 1095 and the 1094. PCORI fees and reinsurance fees, many of these groups do not understand that it is their responsibility to calculate these fees based on the membership of their plan and get that money sent over to the IRS each year on the specified dates according to when their plan began and when it is that they need to do the reporting. So don't let them think, reinsurance fees of course are gone now, but don't let them think that they are going to be taken care of by the administrator or by the stop loss carrier on those PCORI fees, because that will not be true. But the taxes, definitely, the stop loss carrier does pay those taxes back to the state of New Mexico. The other side, of course, the other thing that we talked about was that immunization funding. You don't see a slide on it right now, but I just want to remind you of that too. That immunization funding by the state of New Mexico is still also a separate calculation that self-funded needs to do for the kiddos. Now, the premium and claim funding for traditional self-funded plans are these. So you've got the minimal funding, which is just the fixed cost, plus a small amount to the reserves. That's minimum premium. And typically we do not see employers going that low as far as asking for the employees to share on that minimum premium. We don't usually see that very often. If we do see that, it's because the employer feels very confident that the reserve bank is quite good and they've got enough money in reserves to be able to pay those claims without having to collect any more money to keep building that reserve bank. But like I said, typically we don't see that. Now, expected claims funding is typically your fixed cost plus 100% of expected claims funded through the premium collection. So I do see this where the employer will base its sharing of premium with the employee based on expected claims, because they feel confident that the expectation of claims is pretty spot on as far as the underwriters are concerned, and they don't expect that there's going to be any outliers. And so therefore they feel okay. Plus they also have good money in reserves, so they feel comfortable not charging the employees extra money for more funding into the reserve bank. Now, most groups do go to the maximum claims funding, particularly if they're brand new, or if they're in the second or third year, they're level funded contracts. So they do charge the fixed cost plus 125%. That's your aggregate, 125% times the expected claims funded through the premium collection. And so this is where you see most of the employers going for sharing with the employees, is at that maximum claims funding. That way they know they've got enough money in the bank for reserves for that aggregate insurance to kick in, as well as if they don't need the stop loss insurance, then that rolls over to the next year and they're well funded going forward. So we've been talking all throughout this presentation about different types of administration, but here is a slide that kind of narrows it down for you. So administrative services only plans are usually provided by the health insurance carriers like Cigna, All Savers, Presbyterian, and Blue Cross. They have proprietary networks. So you're going to have, all of these insurers using the networks that they typically use in their fully insured contracts. So just know that you're not going to be able to vary that outside of that ASO. Also, same that is true of their PBM or formulary. It's going to be the same as their fully insured. They are considered to be bundled. In other words, they bundle together the stop loss along with the administration, along with the RX, along with the network, along with any other component that goes into being self-funded. So they are not separated out. You don't have any choices. You can pretty much count on the fact that you're going to get all of this taken care of by the ASO. They have set cost containment programs. In other words, all of these insurers have some kind of a population management, health management program. They've got wellness programs. They have telemedicine programs. They've got all that built into their plans. And so you just need to be able to explain that to your clients so that they have a clear understanding of how to get the cost containment programs going and making sure their population stays healthy. They also feel less risky to the employer and to the employee. Why? Because these are name brand companies. These are the companies that all of employees are used to. They're used to seeing these names. Their ID cards will have these carriers' names on them. The doctors are familiar with them. The claims get processed through the same telephone numbers and the same mailing addresses as the fully insured. So it feels less risky to the employer to go down this path. But if you decide that you want to look at something outside of those bundled services, you can look at a third-party administrator unbundled situations where that key is to match the specific stop loss deductible to the stop loss contract. And so you do need to be very, very careful about matching the stop loss contract to the summary plan description to make sure that you do not have any variances between what the stop loss insurer is doing and what the employer actually wants them to do, and what the administrator is expecting to do. So the administrator has access to lots of different networks. Maybe they have 4 or 5 different networks. Sometimes they will allow more than one network depending upon the size of the group. If the group is fairly large, they may offer a couple of networks. We don't see it typically in the smaller group arena because it's expensive to manage 2 different networks and to manage 2 different negotiated contracts. But we do see the option in larger groups where they can have a couple of different networks. I've also seen third-party administrators process claims as if the claim is in the network, even though the doctor or the facility is not in the network. And why would they do that? They'll do that because the person who's asking for that kind of payment is way up on the food chain. It's typically the owner, typically the owner's spouse, the owner's child, or maybe it's the general manager, or maybe it's the CFO, or maybe it's usually somebody that's higher up in the administration of the employer administration for them to be asking for that. However, you have to be careful with that because once you start asking your TPA to make special exceptions for certain doctors and for certain employees, they have to do that across the board. We can't have any discrimination on health. Remember that. No discrimination on health within these self-funded contracts. And so if we do find that we have a large number of facilities and doctors that are not in the negotiated network, then you need to talk to that TPA about a different kind of network. So a lot of times I'll have third-party administrators reaching out to me and I'll ask them straight out who their networks are. And if it's say like an Aetna network, no, sorry, I can't do business with you. We have no doctors under the Aetna negotiated networks in New Mexico. If I should maybe say none, but we have a few. So we have to be very careful about our negotiated networks with the TPAs and making sure that they actually do fit for our state. And if you've got nationwide employees, that it fits the nationwide model as well. They will personalize their service model, whereas under the ASO, you won't get a personalized service model. The personalized service models with the TPAs that I really like is that they will create a website for the employers that they can use as their benefit website. And they'll do that for free. And they liked creating these websites because it's very easy to do. It's very cheap to do, but it gives all the numbers, links, and able, if you log in, able to see your claims, all the things that a traditional insurance company would have with their website. But the personalized service model website is a website that actually has the group's name on it because they own the contract. They are the insurer. And so instead of having it be on a Blue Cross website and just having it, find your name with your account number, it really is truly a website for that employer. And they can put all of their benefit plans on there. They can even put their 401k plan on that website, and the administrator will do that for them. Now, customized options for plan design and cost containments are built into a third-party administrative unbundled plan. They don't do pull the shelf type designs. They're all customized, and you can choose separate vendors for the stop loss, the network, the pharmacy, and wellness. And so they have their recommended ones, of course. But if you're not liking, like I said, if you don't like that network being Aetna, and you say, "Hey, I would prefer to have a Cigna network," and they have access to that, they will give you a Cigna network. Just know that if you change your networks, if you change your pharmacy PBM, you're going to probably see a price difference in the plan. So just know that, if the network is a more expensive network, in other words, those doctors and facilities are getting a higher reimbursement like they do through Cigna, then the cost for that plan through the stop loss carrier is going to be higher. Um, so just know that Cigna has got a non-compete agreement with third-party administrators. So if you are moving a Cigna group to an unbundled third-party administrator with a different stop-loss carrier, you will not be able to request the Cigna network in that first year because the non-compete lasts for 1 year. After a year, you can go back to the administrator and say, "Hey, we would like to have that Cigna network," and they should be able to do that for you just fine. Um, and then the renewal may not be the same stop loss carrier. You may find that, like I said, I've got contracts out with Nationwide and Gerber and Standard. Um, you may find that those, one group has got Standard this year, and next year Gerber looks better, or next year Nationwide looks better. The nice thing about that unbundled approach is that if you find your stop loss carrier is not coming back competitively for whatever reason, and you want to move it to a different stop loss carrier, you're not going to completely disrupt your group. You're going to keep your third party administrator. You're going to keep your network. You're going to keep your pharmacy. You're going to keep your wellness. You're just changing the stop loss carrier. Does the employee really know anything about that, care about that? No. So it makes it a very easy transition to keep the cost down with the employer by being in that unbundled third party administrative situation versus in a bundled situation. So if you find that your Cigna premiums are just getting too high, or all savers are just getting too high, and you want to get them out of those carriers and put them into a TPA type of a plan, that's going to be a major disruption. That's going to be, I don't understand what's going on, employer, I'm an employee, I don't understand what's going on here. Why is my insurance company changing? And why are you, making me get a new ID card and all of that? So from the standpoint of, less risky and familiar, the ASO contracts are there. But if you want to have more flexibility to be able to move things around, given what your renewal looks like, the TPA plans are a little bit easier to work with. Now, the MGU, Managing General Underwriter Administration, has a number of factors that you should be looking at. This is a checklist, if you will, as a producer trying to evaluate who you're going to do business with on a TPA basis. So use this chart. This is something that I use all the time when I'm talking to brand new managing general underwriters. And I like the MGUs over the straight TPAs because the MGUs typically have been in business longer. They've been in business maybe 20, 25 years, maybe as long as 30 years, and they have established a very nice working relationship with a number of insurance companies. And so those stop loss insurance companies have awarded them underwriting status. In other words, they can authorize the issuance of a group, they can lock in some rates, that type of thing, and they can actually generate the rates on behalf of the stop loss carrier. So I like working with the MGUs simply because their track to run on is a little bit longer. They've got great history. So you need to be looking at their actuarial cost estimates. You need to be looking at what it is that they would charge to do an actuarial evaluation of a certain group. So maybe you're working with a larger, maybe it's a public employer, and you need some actuarial configurations going on with all the data that the public employer is giving you. Well, you can get actuaries from the MGU to actually work with you, maybe charge you a fee. But if their cost estimates are through the roof, then that's not going to help. So can they execute the stop loss contract and shop the coverage each renewal year for you? If they are only locked into like one or two stop loss insurance carriers, that MGU is not going to be that useful to you. You want to see what kind of relationships they have with a number of carriers. So that way, if your group grows, if your group goes down in size, you've got a lot of different options going on there. So they need to do their diligence with their stop loss carriers. Always ask them if they're doing business with stop loss carriers that have at least an A rating. A minus rating would be the lowest I would go. You would ask them about the number of years in business that stop loss carrier has been, what their claims paying ability has been, what is their, how fast do they return those claims? Do they, keep on questioning every claim and do their underwriting at the time of claim rather than at the time of underwriting? Those are things that you need to be asking them to make sure that you're not going to get yourself into a bind with a carrier that is going to be substandard. If you're working with a B-rated company on a stop loss basis, then you should not be offering that carrier. You need to be working with carriers that are A-rated carriers, just to make your errors and emissions insurance company happy, and also for you to make sure that that company is going to be there financially to pay any outlandish claims. You got to make sure that your TPA is negotiating networks for you. Maybe they have two networks and they need to have a third one because you need access to another section of the country or another section of the state. Talk to them about negotiating networks and what kind of division in their organization is dedicating to negotiating networks. If you're finding that doctors are saying, I don't know who this is and I don't want to be any part of that, you need to be able to reach out to the TPA, to their network department, and say, will you please call this doctor and explain to them who you are, what you're doing, what your client is needing, and so on and so forth. And if they've got a good network negotiating team, they will most definitely do that for you. They need to create the medical plan document, otherwise known as the summary plan document. This is going to come out of the administrator. You do not need to hire a separate attorney to draft your summary plan document. So make sure that they actually include that in their administrative fees. You want them to negotiate your pharmacy benefit management and formulary. You want to make sure that you're getting the best return on the dollar for your pharmacy benefit management. You need to look at that formulary. One of the hardest transitions for any group is for that employer to experience, if they have an ongoing medical, maybe they got ongoing diabetics or ongoing high blood pressure or cholesterol medications that are in the formulary of your fully insured. Now you're moving them to self-funding. Is that new formulary going to cover those medications, and is it going to cover it at the same tier? And so you do need to do that research. Don't switch your group into this new arrangement without including that in your research, because you might find that you have made a giant mistake and you don't want your employers to be unsatisfied with your thought process in moving the group. Provide benefit enrollment services. So are they providing you any kind of EDI feeds? Are they providing you with booklets? Are they providing you with fillable forms? These are all things that I look for. I want to see, in particular, the benefit booklet that allows me to create my communications to be in a really nice, pretty, colorful pictures, easy to understand, and address everything that I want it to address. So it is something that can be customized to the group. The other thing is the underwriting rules and forms. And so you're going to need to know what those underwriting rules are, particularly if they are lasering conditions. You need to know what those underwriting rules are for them to be offering coverage, renewing coverage with the possibility of lasering a condition. Now, they need to be adjudicating all the claims with all the vendors with the diagnostic and procedure codes, of course. And so they're going to be using all those ICD-10 codes, and they're going to be using the DRGs and all the things that they have to use with hospitals as well as facilities and doctors. And so they're going to be adjudicating those claims. They're also going to be willing to subrogate claims, and you want them to subrogate claims because you don't want that employer to be paying for any kind of liability claim that could be going against car or homeowners insurance, for example, or workers' comp claims. You want them to be adjudicating those claims on a subrogation basis. And then if you get into a reference-based price balance billing situation where there are no networks, you want that TPA to be able to negotiate the balance bill. So I don't know how many of you who are listening to this know what reference-based pricing is, but typically reference-based pricing is based on Medicare pricing. And so when you get into reference-based, they look at the reference being the Medicare pricing, and then the doctors or the hospitals receive a percentage above that Medicare pricing and no more. That's all they get. Well, there's no contract there. The doctors aren't contracting with the TPA. They're not contracting with anybody to say that that is the maximum money that they should take. And so those doctors and facilities will try to balance bill the patient, and then it'll be the job of the MGU or TPA to negotiate away that balance bill. You need to ask. You need to ask the TPA if they will do that for you. Do they have good success in that? Do you have, examples? Do you have years of experience in that? And if they don't, and they don't want to do it, then don't go to reference-based pricing, because you can save a lot of money with reference-based pricing. You can probably see anywhere from, 15 down to 30% on the premium. But man, if you don't have a managing general underwriter that's willing to go to bat for you on that balance billing, that's just going to be a loser all the way around. Are they providing that population health management? In other words, are they providing a wellness platform? Are they providing 24-hour nurse line? Are they providing telehealth? Are they providing any kind of incentive programs to be in the health management? If they are not, make sure that you do offer that on a carved out basis with a different vendor. But if they are, ask them how much of their administrative charge is going towards that. It might be cheaper for you to outsource that yourself with another organization to get them into a better pricing. So on administration. So ask about population health management. Provide data for reporting to the federal departments. That's where your PCORI fees come in. So make sure that they provide you with that membership information, not only for the feds, but also for the state on that immunization program. Do they provide online services? In other words, are you able to enroll employees, disenroll employees? Are you able to look at claims? Are you able to look at your ag reports online? Are you able to change addresses? All that kind of stuff that we normally are able to do with our insurance carriers for our groups. So make sure your TPA has the same availability. And then find out if they have fees for stuff that maybe you would normally outsource, and maybe their fees are lower than the cost that you've been getting on some outsourced administration like COBRA administration or flexible spending accounts or claim litigation supports or incentive programs. So if they have those services, but they're not built into their typical administration fee, it's an add-on. Find out what that add-on is, compare it to what you've been doing with your normal COBRA administration, for example, and see if you're getting a better deal through your MGU. Do the diligence on the third-party administrators. Ask them if they do independent audits. I mean, obviously they're going to do their own audits internally because they have to. They need to do that for their board of directors. They need to make sure that they've got all the proper financials and whatnot. But do they have outside independent audits going on so that you can make sure that they aren't just looking at themselves internally, that they are actually looking at everything else on how this organization is actually working. Now, one of the things that I love doing with my own personal independent audit on a third-party administrator is, since we don't have any here in New Mexico, in the past, before the COVID, I was getting on planes and actually going to the third-party administrator's office so that I could see how they're set up, how it is that they've handled HIPAA, how they've handled their technology, how they've handled their call centers. So that way I can feel comfortable. And then I also get to meet, of course, with the owner, the administrator owner, and I also get to meet with the people that are at the top of the administrator making the decisions for that administrator. So I get to know folks, and I can call on folks to help me when I'm in a TPA situation. Now, a lot of the third-party administrators, similar to the insurance industry, are selling out. They're selling out to very large third-party administrators across the nation. So you might find that they are now recently acquired, haven't changed their name, but they are recently acquired by a different third-party administrator. So you need to find out who their true ownership is. If they are owned by a conglomerate TPA, then you're probably going to have a harder time getting to the conglomerate TPA's office and meeting the people who really make the decisions. So I do like those smaller third-party administrators where I can get to the owners, look at the history, and have them give me my own sense of security in my own little independent audit. Processing controls include their marketing, their administration, their claims processing, claims support, eligibility, billing, and accounting. So are they doing all of this on a good control process? Are they doing it quickly? Are they doing it accurately? Are they communicating it to the insureds? And so you need to know what the processing controls are on all of these different levels. You can ask them what their success rate is in all of those levels and ask them if they can provide any kind of quality control back to you as the employer, the owner of the contract, if they fail. If they fail with the administration in any way, shape, or form. General controls are like organizational management, security, computer operations, backups, and recovery procedures, physical security, hardware and system software, application maintenance, and documentation. Those are general controls. And so, like I said, I like seeing those as well as having conversation about those, particularly with the backup of all the information to make sure that obviously if there's something that goes wrong in the building itself, it lights on fire, you don't lose all your data. And so this is just really super important things for all of us to be paying attention to for choosing a third-party administrator. So formal internal audits on all claims exceeding a set dollar amount and random audits of all claims under that amount. And the industry claim processing standards are these. If you find that they are able to give you these standards back, and most of the time you want them to be in that excellent category, you don't want to be, inching down into the acceptable or good category. If they have internal auditing and they are hanging in there with that excellent level, can you ask for any kind of reimbursement on administrative charges if they fall below the excellent category? So make sure you do ask about those quality controls and what kind of internal auditing they have going on so that you can then factor that into your contract negotiation. Administrators' best claims practices. So containing the cost for high dollar claims. So they do need to do this for your groups. They want to make sure that they are negotiating the best price they can possibly negotiate for high dollar claims. You don't want them just to automatically pay out whatever the hospital or the doctor is asking for because they could be overpaying, particularly with hospital claims. You got to make sure that they're not paying for something that never happened. So you want them to develop a systematic cost containment approach toward higher dollar claims, including appropriate treatments, medical necessity, and creating a price comparison protocol. So what we mean by price comparison protocol is, hey, you've gotten a prescription from your doctor to go to XYZ laboratory. Well, this particular administrator knows that XYZ laboratory is not the best cost-wise in your local city or county or rural area. So they're going to recommend a different one so they can do a price comparison for you and make sure that you're going to a cheaper facility. Also, you want them to assess if there are any opportunities for cost containment for the services that they provide. We got into that centers of excellence conversation. Can we fly you off to MD Anderson for your cancer care? Is that cheaper? Is it better for you to go to a center of excellence that really is good at, any kind of surgeries, maybe a back surgery or maybe a knee surgery or hip surgery? There are centers of excellence all throughout the country. Minnesota has quite a number of centers of excellence for any kind of knee, back, hip surgeries that are much, much cheaper than New Mexico. So if you've got a third-party administrator that knows about these centers, has agreements with these centers to get the pricing down, they will pay for that claimant to fly out. They will put them in a hotel, and they will make sure that that outcome is a good outcome. Assess them for the direct primary care contracting. The jury's still kind of out on the DPCs as to whether they really do reduce the cost of the programs. If you have a DPC where the employees all have the same access to the same primary care doctor, in other words, they're not fighting with the rest of the population to get in to see a primary care, there's no waiting list, that type of thing, if they're able to get in, sometimes that is a cost lowering technique, particularly if you're seeing a primary care physician that is not prescribing a lot of specialty care. My experience with this is that the primary care doctors are taking on less and less risk. They like, doing very, very minor things. And if they see something odd come through, maybe a laboratory, a blood test that is, and they don't really know how to read that lab very well, they're going to keep on throwing you off to specialists. And so that is not going to save the plan any money. And it's going to cost the employer a lot of money to have a direct primary care contract, because they're the ones who pay for that, not the administrator. But some administrators will lower their administration fee if there's a DPC arrangement. Not all of them will. Step therapy, RX, and fill limits, of course, are going to be part of any plan. We've been seeing this for years, but one of the things that you need to find out is there step therapy for RX? Just over the top, way too strict, and you need to find out within your group if you've got some of those ongoing medical conditions, whether it's an asthmatic or somebody who's on high cholesterol medication or somebody's on high blood pressure medication. The last thing you want to have happen going into a new third-party administrator with a new pharmacy benefit manager is for them to start all over again with their step therapy. So you want them to be able to access the same level of medication that they are used to accessing without having to go backward in their medical care. And you don't want them to have fill limits on an ongoing medication that somebody may have been taking for the last couple of years, and they definitely know that medication is working for them. Prior authorizations, doesn't matter whether you are in a third-party administrator or whether you're in an ASO contract. All of these are going to require prior authorizations on certain things like surgeries that you could control, any kind of large MRI, CT scans, PET scans. Those types of things are going to require authorizations. And so just find out what the rules are with your administrator for those prior authorizations. Who's going to handle them? How it is that it gets communicated? How are you going to find out that they've been approved? And you can move forward with the treatment that your medical provider has prescribed. Those are all things that need to go into your discussions with your administrator. And then, of course, your administrator is negotiating with the out-of-network provider to get the signed release showing that the provider accepts the negotiated charge in full and will not balance bill. This is where we're getting into that Medicare Plus kind of billing, where you're just asking for trouble if you don't have contracts. But if they are willing to negotiate with those out-of-network providers on a reference-based pricing for you, and they have a track record doing it, then by all means, definitely evaluate whether that's a good option for your employer group. TPA or insurer reporting components on the aggregate. So remember what I said when you're moving your group. You're not going to be doing a typical, hey, here's your census, hey, here's the renewal, hey, or here was their last year's rate compared to the new year's rate. Okay, carrier, give me a new bid. No, you have to give a whole bunch more information to a third-party administrator or to an ASO carrier in order for you to move a self-funded group to another self-funded group. So you need to know what the cumulative claims funding is. You need to know what the cumulative claims payments are. You need to know what the stop loss claims payments, both specific and aggregate. You need to know what the large claims are over a certain threshold. I gave an example here, say over 25,000. Sometimes it goes as low as the 10,000, depending upon where your specific deductible is. You need to be able to give them demographic information, membership information, inpatient trends, outpatient trends, whether it's a urgent care, emergency room, primary care specialist, or any kind of outpatient surgery. You need to give them utilization on telemedicine or wellness, 24-hour nurse line, if they're using any of that stuff. You need to give them trends on whether they're going to the retails or using mail order. And you need to give them, and this is really important, if you can give them the top 20 prescribed medications by cost, by plan spend, and by volume, that will tell the new third-party administrator that has MGU underwriting status a lot. That'll tell them how this employer group is really trending over time, how the medical conditions are getting solved or whether they're ongoing. All of that is coming through that top 20 RX report that you give to the new carrier. Okay, so we're nearing the end of our seminar today, and so you'll be finishing up here fairly soon. We're at slide number 103, and there are 109 slides. But I do like going through this little case study, if you will, to kind of test your knowledge of what it is that you have learned over the number of hours that you've been listening to me. Today, you have learned about all of these bullet points. You've learned about the counting of employees, what to look for as far as the number of years in business, what kind of entity they are, what kind of HR department do you have, SIC coding, all of this we've been talking about. But this is a particular case study. It is an actual group. And let's just talk about it for a little while. So now we've got an employer group that is considered to be an applicable large employer. Why? Because they have 120 full-time employees, which is well over 50, and they also have 50 part-time employees, and the group is growing. So in other words, this group is changing. This group is not staying constant. How much bigger are they going to get? Probably not much bigger. Maybe they'll be adding 10 to 20 more employees on a part-time and full-time basis, but they're not going to be jumping up with, 100 more employees going onto the plan. So that actually is an okay thing to have going if it's growing, but not by that much. The fact that it is over 50 employees makes it a good candidate for self-funding because it's got enough employees there to aggregate together to fund that claims bank. And so that's on a just a pure basis all by itself is a pretty good indication that you should be talking to this group about self-funding, partially self-funding with stop loss insurance. Now, this business has been in business for 15 years as a C corporation. In other words, they are not an LLC. They are not a subchapter S corporation. They are not a nonprofit. They're not a partnership. And so as a C corporation, you can feel safer in a C corporation arrangement that the owners of the business are going to be able to participate in the program as any other employee. Why? Because the corporation really is the owner of the business, not any one person. It's not a pass-through to a person like a subchapter S corporation is. And so that's another really good indicator for it being self-funded. So those are two really good indicators. Number 3, the HR generalist with an assistant. There's only one person is an HR generalist. That assistant doesn't have any degrees in HR. She's just there to help the HR generalist. But both of them really don't have any benefit management background. They are really trained in basic HR components like hiring and training and making sure that all documents are in order for the organization for the management of the employees. But when it comes to benefits, they don't really have any experience with benefits other than they pay the bills and they just hope and pray that the insurance company pays. So if they really don't have that kind of benefit experience, maybe that would be your first negative tick on putting them into the self-insured arena because they don't really have a good understanding of finance anyway. If they have to go to their accounting department for everything, and the accounting department is not really up on this either because the benefit managers have never been there to bring accounting into a discussion, then you might find that that's going to be your first negative bullet for bringing this group into a self-funding. Now, that doesn't mean that you don't talk to them about self-funding because they may be a good candidate going down the road. Maybe 3 years from now, 2 years from now, they'll be a good candidate because you will be doing your job as a producer over that period of time to keep on reminding them what a fully insured contract does versus a self-funded contract, and reminding them about the flexibility, reminding them about customization, reminding them about composite rating, those type of things all along the way. And they may get more and more comfortable with it because you've done your job as a producer in consultation with them, and they get more and more comfortable with it. Then you'll be able to flip the switch on it when you're ready to flip the switch. Now, the SIC code for this particular business is lodging, and half of their population is Spanish speaking. That makes it a difficult situation. So could be another negative for this particular employer. Why? Because lodging, even though it looks stable with 120 employees and it's growing, lodging has a pretty high turnover rate usually. And so when you're adding employees and deleting employees on a constant basis, that communication tends to break down. The HR department tends to get lazy. They tend to get overwhelmed with explaining benefits all the time. And so they may decide, I'm just going to go the easier route and be fully insured. I don't have to worry about misstepping or hiring somebody that's going to tank my plan because I got these really great rates on renewal this year because my group was super healthy. But now I'm entertaining conversations with employees that I can't ask them about their medical because of HIPAA. I can't talk to them anything about medical stuff. They can do a medical evaluation on that employee for purposes of work. Are they able to lift? Are they able to, go up and down stairs? Are they able to um, experience extreme heat or extreme cold? They can do those kinds of things, but only after the employee's been hired. They can't do that upon the hiring process. And so that doesn't help your stop loss thought process when you're hiring people when you basically know nothing. And once you've gotten past that initial underwriting and you're adding employees, you're not asking those new employees to fill out the universal medical questionnaires. They only fill those out on the initial underwriting and the initial pricing. So you're running a risk with high turnover businesses to be in a self-funded arrangement. Not to say that they can't do it. I'm just saying it's a little bit higher risk. They are currently fully insured, which means that, of course, there will be a disruption if you move them from fully insured to self-funded, particularly if you go the ASO route. They are not going to recognize the carrier name. They're not going to recognize the network name. They're not going to recognize the pharmacy benefit manager. So there are lots of different pitfalls on communication if you're moving fully insured to the TPA world. But if you're going fully insured, say with Blue Cross, and then go to self-funded Blue Cross, then, of course, it's a lot easier. The number enrolled in the medical is 72, which means 67% of their eligible population is enrolled in the medical. Well, that's okay. It's definitely not horrible. The insurers definitely like to see something above 50%. Once you below 50% on your actually number enrolled, we're talking employee lives, we're not talking about any dependent lives here. Then you're going to get declinations. You're going to see your carriers on all levels, whether it's ASO or whether it's TPA. They're going to decline this group. But because this group is above 50% enrolled in the medical plan, you do have a better chance of getting a stop loss carrier to pay attention to this group. Now, the contribution method is based on affordability testing for this group because they are an ALE. They have to go through the affordability testing. So they're going to look at that lowest paid person that's eligible for the plan and multiply it times that 9 point whatever number it is, and make sure that the contribution of the employer is meeting that affordability test. Now, this particular employer is contributing $150 a month to the bronze plan. That actually does meet the affordability test based on the premium of the bronze plan with this employer. They've got extremely competitive rates in this group. And so the 150 actually is meeting the affordability test. Now, you might find when you get into the self-funding that the 150 isn't making it, that the rates that are coming back from the stop loss carrier in combination with the maximum funding for claims and the administrative charges are not coming anywhere near the affordability test on $150. And so if that happens, then of course that is an option on the stop loss carrier and administrative that's going to be thrown out. You're not going to meet the budgetary requirement of that particular employer. The average age of the group is 45, which is fairly high. That also does not spell out low rates on the stop loss side, so that is working against you. There are more females than males in this group, which is also working against the group because the females are going to be using the plan more so than the males are. And like I said, that lowest hourly rate on that 150 affordability test, believe it or not, is only $14 an hour. So a full-time person making $14 an hour is not making very much money. And so that makes that affordability test very difficult to meet on contribution, particularly if you're doing it like this employer, which is a defined contribution basis. Last year's claims losses were low, but this year it looks a little bit higher. They're at about 90%. They're still below 100%. We all know within the fully insured market, we like to keep that loss ratio below 80. If we can, that's what makes the group a more successful group and moving it to the stop loss market. We did get reports. We had a full-on report for this group from their carriers so that we could actually evaluate it with the fully insured carriers as well as the self-funded carriers. It really didn't make much sense for me to move this group at all to self-funding because of all the different factors that you see there in that case study. So hopefully this seminar is giving you enough information so that you can use these bullet points in evaluating any current groups that you have, any new groups that you've got coming across your desk for their viability to go into the self-funding, and that you're not making a mistake by putting them in self-funding too soon. Because like I said, if you've got somebody in that HR department and nobody in the finance department that understands what you're doing, then you really need to be staying within that fully insured arena. Here's some statistical numbers regarding high cost claims with the specialty injectable drug trends. So I put it in the stop loss mark because of Sun Life's reporting. Sun Life's reporting is outstanding. And so, but you can pretty much translate this into the fully insured market as well. Because if the self-funded market is experiencing this, then most definitely the fully insured market is experiencing it as well. So when you look at medical conditions in years 2015 through 2018, the highest ranked injectable medications or specialty medications are coming through malignant neoplasms, in other words, cancers. And cancers are there again in this number 2 slot for lymphomas and melanomas. And then we have end-stage renal being next. And then congenital anomalies with conditions at birth, way high. I remember the days when we were selling fully insured contracts that had $1 million limits on them, or $2 million limits. And I used to assure my groups, you're not going to get to $1 million. It's not going to happen. The only time you'll get to maybe $1 million would be with a preemie birth or with, some kind of congenital illness going on with birth. You'll get to $1 million claim there, or maybe, massive burns. Those would be my $2 million claim examples. Not anymore. We see it with the cancers. We see it with the transplants. We see it with septicemia. Septicemia is awful. Septicemia will kill you. This is how a lot of the COVID people are dying, with massive septicemia infections. Costs a fortune. Why? Because the bacteria that gets into the bloodstream of a very sick patient is not able to be cured with the normal antibiotics, because we have antibiotics everywhere in our food system. And so therefore our bodies are so used to having antibiotics in it that it doesn't fight off these infections the way it should. And so anyway, you've got this massive list of things that bring these claims well over $1 million, which is the reason why the Affordable Care Act brought our medical policies out to unlimited policies rather than stopping at $1 million. Now, the likelihood of a stop loss claim. So here again, this is another Sun Life stop loss research report dating back to 2018. They haven't put out their 2019 info yet, but high cost claims are not always predictable. We know that. Stop loss insurance reimburses the employer for the portion of the claim that exceeds that stop loss deductible, right? We've been talking about that. So when you're looking at the $1 million claims, 7.9% of them are over $1 million. 19% of those claims are birth related, and 59% of those over $1 million claims are cancer claims. And then 62.8% of those $1 million claims are injectable stop loss claims, injectable drug stop loss claims. And then, of course, 84, we do the math, add all that up. 84.9%, any stop loss claim is eating up these $1 million policies. More information about the $1 million claims and injectable drugs. Maybe you'll recognize some of these drugs within your group. You know, all of these medications are super expensive. Sometimes they have discounts associated with them directly from the manufacturer. Sometimes they don't. So I've asked on occasion to remove some medications from the formulary simply because I want a patient inside of that group to be able to get the discounts. So if these medications are on the formulary of your plan, and the patient actually applies to the manufacturer for discounts, they won't get it because they're already getting the maximum discounts within the formulary and the pharmacy benefit manager. But if you remove them from the formulary for the sole purpose of saving the group some money, this is a cost containment strategy. If you remove them from the formulary and then ask that employee to apply for a discount directly through the manufacturer, not only will the manufacturer be looking to see qualifies for the discount. So don't assume by removing the person from the or the medication from the formulary that it will translate into it being covered by the manufacturer, because they're not. That's not true. They are going to be doing an income-based test on that employee to see if, in fact, that employee it qualifies for the manufacturer discount. Okay, let's talk about your broker fees. It is a conversation that you need to have with a group. The group will be signing off on your commission. It will show up on the application, especially if you're in a TPA arrangement. And so you need to be 100% transparent with what it is that you are earning on this group, and that you need to communicate to the group what it is that you would like to earn based on the work that you are doing for that group. So when you look at the fully insured on the right side of that screen, if you're looking at a fully insured small group, 25 employees, the commission is going to be anywhere between 5.5%. There are 25 employees on this plan, total of 35 employees. That 5% gets multiplied by the total premium of $20,000 on all 35 being insured. And so your commission on that group is $1,000. Now, if you move this 25-person group over into a self-funded arrangement and you want to maintain that monthly compensation, and I would suggest that you do want to maintain that, because you're actually doing more work with a self-funded arrangement than you were with your fully insured. We went through all the steps here with this course that you've been taking on how much work it is to not only move the group from fully insured to self-funding, but to maintain that group in self-funding. It is a lot of work. And so you want to be able to justify how much that you're getting paid. So the math on this is, if you go to $30 for 25 or $35 for the 25 and $40 for the 25, it's never calculated on the 35. It's only calculated on per employee per month. It's not per life per month, not per member per month. It's per employee per month. And so you need to you're backing up into that number in order to get to in equal compensation. So this example is putting out that you need to get at least $45 per employee per month in order to meet what you were earning on that fully insured contract at 5%. Now, you may feel uncomfortable with $40. Personally, I don't. I don't feel uncomfortable with that. I can justify it all day long. You just ought to make sure that you are making the employer aware of all of the work that you are doing and all of the moving parts, and they understand that you are worth what it is that you're getting paid. Obviously, you can go above that. You can go to $45, but you got to understand, when you're looking at a bid straight out of the chute from your ASO carriers, Blue Cross, Presbyterian, Cigna, All Savers, they're going to build in a typical PEPM for you. They're going to build in, maybe they'll build in $28, maybe they'll build in, $30. And if you do the math on that, if you don't see that immediately when you're looking at the proposal, because it's in the very fine print of the proposal, if you don't see that and you issue that plan based on the rates that they have given you and you've locked in those rates, oh, you're not going to be able to change your compensation. That's just all there is to it. You're going to be taking that lower compensation for that plan year, and you won't be able to change it until renewal unless you want to disclose to the group that you didn't realize that you were getting paid too little and that you want to increase it, which of course means that their premium rates are going to go up. So pay attention to those proposals. It is built into the proposal on the PEPM. They're going to go on the standard. They're not going to ask you. They're just going to issue what that is unless you put it in your RFP on what you want your PM to be, and therefore you'll get what it is that you deserve, and the rates will be built the way they need to be built for you to get what you deserve. Now, are you going to have to pay taxes on the fees? If you are receiving your fee directly from Cigna, Blue Cross, Presbyterian, All Savers, or your TPA, if you're receiving it directly from them, then no, you do not need to, and it's all related to the cost of the insurance. It's built into the administration of the insurance. Then there is no fee for you to pay because the premium tax is being collected on the stop loss premium and so on and so forth. Now, where you do need to pay taxes on consulting fees is if you are doing consulting outside of the insurance product itself. So if you're doing some consult on, all the rules and regulations that go with HIPAA, all the rules and regulations that go with the Affordable Care Act, all the rules and regulations that go along with COBRA. If you're teaching classes, like that type of thing within your employer groups, and you're charging a fee for it, then those fees are going to be subject to the gross receipts tax and state tax that you would normally pay. Receiving income. So this is just a very little example on how it is that you're going to work out your fees. Be straight up with that. Have a good conversation with your employer groups about that so that there are no surprises with their premium. This is how I like you to evaluate what we've done over the last number of hours. Did I give you some good checklists that you can use going forward to decide whether your group is going to go from fully funded to self-funding? Did I give you a good checklist on the ASOs? Did I give you a good checklist on the TPAs? Did I give you a good checklist on the Department of Labor? I think I did. But if there's some questions that you have, remember to come back with those questions. This is going shorter. Your session for today is going to be finished here with one more slide, but it's shorter than the 8-hour course. Why? Because I don't have any of you asking me questions all throughout the class. So I'm able to just kind of rush through these slides and then hopefully we'll get some questions from you thereafter. Hopefully I gave you the New Mexico rules compared to the Fed rules, and you're feeling good about that. And then also the biggest thing, of course, is increasing your confidence level in being out there in the market and talking about self-funding versus fully insured, and making sure that your clients understand that you are confident and that you feel comfortable making a recommendation one way or the other. So that would be my ask of you, is to evaluate this. Just do it internally, whether you want to send me a note and tell me how it is that you liked the class. I would love that. But otherwise, the last slide is just my contact information. Ann Sperling at Vanguard Resources, Inc. is my email. Be sure to send me your questions. I'll do my very, very best to get back to you within a 24-hour period of time. And I thank you for your time, for listening. I thank you for your investment in the independent insurance agents. I thank you for your investment in your own career. Have a wonderful day.